Perfect. Thank you, Thomas. And thanks to the organizers. And in this instance, particular thanks to the people like Valentin, who's making sure that technically we are able to broadcast this. So a grand welcome to all of you. Thank you for participating. Very topical forum today. So with this panel, what we have assembled is both geographically as well as with respect to the style and approach to investing, a very diverse and distinguished panelist group. And we will be talking about a number of topics. So as a quick way, let me first introduce myself and my co-host Arturo, or co-moderator Arturo. And let's kick off with a quick round of introductions, and then we have a set of questions for all of us to answer. So I'm Bibhash. I've been with New Enterprise Associates, NEA, primarily US-focused venture fund. We do investments in Europe as well. And I focus on biopharma, been with the firm for the last 5 years, and prior to that was at AstraZeneca and J&J in various BD corporate strategy capacities, and prior to that trained as a scientist. Arturo?
Great, thank you, Bibhash. So just briefly about myself, I've been with Wellington for over 1.5 years. As you know, Wellington is a life science VC fund based in Germany, currently managing a portfolio of around 30 companies or so, and investing from our fund number 5 that we closed last year of around 200 million euro. We are the typical Series AV investor, and we have kind of a broad life science scope. So we invest from therapeutics, diagnostics, medtech, and digital health. So that would be myself in a nutshell. And maybe, as you mentioned, Bibhash, we have a really interesting panel today with different investment philosophies. So let me quickly introduce them. I think the best way is just to mention your names and just do a quick intro to the audience. So let's see who I have here in the screen. So maybe the first one would be Meredith, if you want to introduce yourself.
Sure. Thanks to the hosts, and thanks, Arturo. So I'm Meredith Fisher. I'm a partner at Mass General Brigham Ventures. We are the strategic venture arm of Mass General Brigham, which is the largest group of academic medical research centers affiliated with Harvard Medical School in the US and in Boston. And so my role on a day-to-day basis is to identify, originate, on occasion, and ultimately invest in companies that are formed on the basis of discoveries made by researchers within our healthcare system. That is about 7,000 researchers, and we receive somewhere around $2 billion of funding for our research every year in the form of grants and other zero cost of capital dollars for us. I've been with the fund for almost 5 years now, primarily focused on therapeutics.
That's great. Thank you, Meredith. Then next one would be Bernd.
So, hello, everybody. My name is Bernd Goergen from high-tech Gründerfonds, which is currently one of the biggest seed funds in Germany and in Europe, to be honest. And I'm a partner in the life science team since 2008. Before that, I was trained as a biologist and spent 8 years in marketing of a diagnostic company and later on 7 years in investment banking. High-tech Gründerfonds, as mentioned, is a seed fund focused on Germany. We have over 300 companies in our portfolio, ranging from hardware over software to, not surprisingly, biotech and healthcare. So in our definition, life sciences comprises everything from medical devices, diagnostics, digital, and drug development. And also, if you will, white biotech, blue biotech, biotech in every color. And we begin with an initial ticket of around 600,000 euros, either equity or convertible bond. And over the lifespan of a company, we can spend up to 3 million euros per company. Thank you.
That's good. Welcome. Then we have Marian.
Yes, hi, everyone. Marian Nakada. I'm with JJDC, Johnson & Johnson's corporate venture group. I've been in this role for 7 years, and before that, would have been in Janssen business development and a lot of my career in R&D at J&J and what was Centocor. So we invest in all 3 sectors that J&J is active in: pharma, consumer, and healthcare. Our investments are on strategy for what the R&D folks are interested in. We invest at all different stages, from seed convertible notes to Series A, B. We'll even do pipes to support business development deals, and all different check sizes. So wonderful to be on this panel.
Wonderful to have you. Next one would be Patrick.
Yes, thank you, and hi everyone. My name is Patrick Pfeffer. Originally from Frankfurt, Germany, bioinformatician by training, with a couple of stages in the pharmaceutical industry, mostly in the commercial space. Ex-managing director at WebMD, was taking care of launching Medscape.com in the European landscape, and since 2014, founder and CEO of aescuvest, which is a digital investment platform to foster and fund medical innovations. So we make venture capital accessible to European citizens, and we operate that platform jointly together with EIT Health, the body of the European Union, which is one of the largest healthcare accelerators worldwide. Looking forward to the discussion with you guys.
Great. And then last but not least, we have Gilles.
Yeah, thank you. So I'm Gilles Nobécourt. I'm with ANDERA partner based in Paris. We invest in 2/3 biotech, 1/3 medtech, 30% in the US, 70% Europe, and we have about 2.5 billion euro under management. And our last fund was about 350 million euro.
Good. So I think we are done with introductions. So now it's time to put some meat to the bone. Actually, I would like to start with one quick question for our panel today. So it's not a surprise that Corona has brought us together to this kind of virtual panel here today. And so my first question is, are you seeing new opportunities related to coronavirus in your deal flow? And if so, how bullish you are about them? So I don't know who wants to take the question. We will just keep it, open and have a chat between the participants. Should I just mention one? Let's start with Marian, maybe.
Yeah, sure. So, I think all the portfolio companies are looking at the different therapeutics that they're developing and wondering whether or not there's an association of COVID with their targets, with the idea that they could direct them to something that would reduce the symptoms in terms of, let's say, the host response to the disease, or in some instances, folks with vaccine platforms or antibody platforms are trying to determine whether or not they could, for example, develop a therapeutic antibody that in lieu of your own circulating antibodies would be able to neutralize and either prevent or, change the trajectory of the disease. So I think they're all interesting propositions, especially because there's a lot of grant money and non-dilutive funding that you could get. I think the challenge is, are these things going to see the light of day in time for when there still is a COVID problem? So obviously it's a race with the vaccine. So I think the question we put back to all of these opportunities is, make sure that it's not too little too late, because, it becomes an opportunity cost to be developing something that is hopefully going to be more sustainable rather than something that is hopefully with COVID transient. And I'll also say there's a lot of interest in obviously diagnostics, both for viral load as well as for antibody testing, because it's not just the presence of antibodies, but whether or not those antibodies can neutralize COVID, which I think are important. So I would say it depends, but you also don't want to just go whole hog just because you can get non-dilutive funding if in the end that the solution that you have is not really enough in time.
Mm-hmm. I fully support on those lines. And do you have the feeling, maybe to Patrick, because he's seeing more early stuff, is really a clear medical need, or is just people getting creative in the space?
To be honest, both. And I think we as investment professionals have to really take care of that. We take a closer look at the sustainable stuff as opposed to the opportunistic stuff, right? Certainly, we are human beings as well. And I think the crisis was a shock for us all and also for our investment analysts who are by the way, human beings as well. But then certainly, after a certain period of time, when we've been seeing a lot of things, I think the picture was pretty clear that the majority of ventures were trying to go down the opportunistic path, which is probably not something for us. I think we as specialists here and as futurists, so to say, should usually go down the sustainable path, which we do certainly in our case.
Mm-hmm. Thank you, Patrick. And maybe Meredith, do you want to comment on that topic? I mean, or Bernd?
So I would say that within, because we primarily source our deal flow from technologies and opportunities that originate from our healthcare system, you can imagine, particularly as we hit pause on a lot of the elective procedures and other things that the hospitals would normally do, including pause on all of our research for a few months because we could not populate the labs. We had a significant increase in interest and ideation of things that could be positioned for COVID. It's an incredible depth of science and creativity that we can source out of. And so I would say we were in a no shortage for ideas, but I think back to the points that the other panelists were making, it's then our job to understand whether any of those actually are real, could work, not just mechanistically and technologically, but then also clinically and commercially. And I would say that we set the bar incredibly high during this time, and probably will emerge with maybe one thing that we would write a check for, but that had to have a platform component to it beyond COVID in order to generate a full thesis for us to actually make that investment.
Mm-hmm.
I think one other aspect of this is I work for Johnson & Johnson, and our vaccine is something that we are going to provide on a nonprofit basis. That creates a problem for the business model for folks, right, who are, let's say, venture funded and are looking and can't go that route. So I think the notion about Meredith's point about the commercial case for this is also a bit of a challenge when you're talking about the need for global health and not necessarily affordability for all.
Yeah, because Marian, we wrote you guys down as a group that is unlikely to acquire a new technology, given what was wonderful that J&J did, but doesn't necessarily create a commercial opportunity for us from an early stage venture perspective to actually put money to work, thinking that then J&J on the other side of that could be an acquirer for that business, specifically around COVID, right? So we looked at what pharma was doing with a lot of admiration and respect, but it wasn't necessarily market making for venture.
For venture, exactly.
So let me add another twist to this or way of thinking about this. So does it mean that the barrier to entry for a small venture funded endeavor, looking at diagnostics or therapeutics, keep vaccine aside for a second, but in those two spaces will be incredibly high given the competitive intensity in the space and the presence of very well-resourced organizations like J&J, Regeneron, and Moderna, etc. Or Moderna is more of a vaccine, but nonetheless, would the barrier to entry be significantly high? And for early-stage companies, and maybe Bernd, you can start here. How does that factor into your decision-making on making an investment, the outcome for which will probably be a couple of years down the line from an investment perspective?
Okay, let me comment on that. For sure, we see a lot of business plans looking at corona-related problems, but that is not only the case in life sciences. I mean, we, not in the life science team, but my colleagues in the hardware and software teams, they see deal proposals, for example, relating to getting people together online, or fighting depression or something that is also related to social distancing, which is one of the consequences of the current pandemic. So we take a look at that as well. Regarding therapeutics and vaccines, if there is a new startup aiming at developing the next generation vaccine, well, the barrier is a lot higher because it takes for them another decade to get to the market. The chances of success are pretty low. And even if they are successful, we have to envision how big is the advantage in comparison to technologies that are going to hit the market in 9 years. Is it just incremental, or is it a must-have that the healthcare system is willing to pay for? And the situation at High Tech Gründerfonds is so special because we have now access to a relatively generous program of our government to support startups in Germany. And you can imagine that people are getting very creative to demonstrate that their problems currently are just corona-related. For a lot of them, this is true. For some of them, this is probably not true, and they would have had problems even without corona in normal times. So we have to make a very close look at what they are proposing, and some of the ideas are just excellent, but might hit the market too late, and some of them are just to try to get additional money from the government. We have to distinguish that. We have to make a triage, as doctors have to make a triage for patients, just select those who really profit from money.
Excellent. Well, let's. Sorry.
Bibhash?
Yes.
Gilles, just like to make a comment on the the threshold of technology. Let me give you an example that could also generate opportunities. I know of a small company which has a technology of self-test for pregnancy. Mm-hmm. These people were able to adapt their technology to provide serology tests for COVID in 3 weeks. In 3 weeks, the test was adapted and they could provide the serology test. So here they had, technology platform, which was immediately adaptable to the need. And beside this, I think we should all keep in mind that therapeutic innovation is based on building set of data, does not happen from one day to the next. And it's very, very dangerous to follow fashionable theme. Our job is long-term innovation, does not happen from 1 month to the next.
Gilles, may I ask a question regarding that? Because I'm very interested in diagnostics, but I cannot imagine if you just transfer an antibody test to, let's say, point-of-care platform, that this antibody test has been validated in the same way as another, let's say, antibody test or antigen test or even PCR test that is routinely used in diagnostics for COVID. I had a hard time to believe that 3 weeks old, or that a company that is developing within 3 weeks an antibody test for use at home will deliver really reliable results. And the risk of creating false negatives is high. And also regarding false positives, it's not a joke. And I would look very critically at a company that is providing me with an idea. Nothing against your decision, but regarding, it shouldn't be underestimated what are the consequences of wrong diagnostics, even in SARS-CoV-2.
No, indeed, but that they did not even need money because the orders they received from the army were so huge immediately that they just could do it without any need for additional financing.
So this is fascinating because what it encaptures, based on the perspective of the panelists here, is that there is recognition of the public health need, there is adaptability of an existing test or a product, and quote unquote purpose build that for COVID, both in diagnostics and therapeutics. But then the investment barrier has to be appropriately calibrated against that, so that at the end of the day, all our investors are obligated to our LPs to provide returns. So not losing sight of that while making the investment is critical. So fundamentals of the business is what investors are focusing on in the longer term, rather than the flash in the pan. Mm-hmm. Excellent. So here's the obligatory question: how has sort of your deal flow, etc., been affected? What advice are you giving your portfolio companies? And in this instance, this is a fairly standard way of thinking now that it was, we have been sort of 4 to 6 months into this, depending on the country. Some of us are still going, some of us have sort of gotten off the off the curve. But maybe we can start with Patrick this time, because he sees given the stage of the companies you get to see. So what's the overall sort of thought process in the early sort of angel and family office based capital raising for these companies? How has that affected your deal flow and the portfolio companies of yours? And then we can go around.
So let me start with the startups. So overall, we're talking about around about 25 companies. They're doing pretty well, luckily. However, here and there, there's one or the other struggle for a company. Let me give you an example. Single-purpose medical devices, a trade company, so to say, and trade went down by X%, almost down to zero. We know why. So certainly they were under pressure. Then there are a couple of examples when it comes to clinical research, and then it was really down to a partner question. Can the partners in a clinical development environment really provide what a company needs at that point in time? And the answer was sometimes yes, the answer was sometimes no. And we're also putting a little bit of pressure on some companies' shoulders. On the other side of the house, because we also have to take care of investors as well, is, I would say, rather a 50-50 answer from our investor landscape, where 50% were saying, guys, I really have to take care of my portfolio companies. It's about saving cash and in further investing into them. So no chance for something new right now. And the other 50%, I'm pushing the boundaries here a little bit maybe, were answering, if not now, then when? But they were pretty aggressive when it came down to the company valuation. So a minimum of 25% was tried to negotiate it when it comes to the company valuations.
Perfect. And maybe we can do it in the order of answering here. Meredith, Bernd, please jump in, and then Marian and Gilles, just given the stage of companies you typically get to see. Meredith, Bernd, yeah.
Meredith, okay, then I'll take the next one. So deal flow is dropping a little bit. Meaning that the companies know that fundraising is going to be difficult in these times, because it's pretty much like Patrick already said. There are some investors that are keeping their money together because they know they will need it for their own portfolio. And the second sort of investors is they still have enough. They are a little bit bolder, and they say, well, it's time to generate returns or to generate profits in the future. And they jump onto the valuation game, which is sometimes a little bit demotivating, especially for the company. So on the average, I would say the tendency to keep your money in your pockets is bigger than the appetite for new investments. So that's our current observation.
Mm-hmm.
So what I've been seeing is a lot of risk planning. So a lot of companies are doing the red, yellow, green scenarios. Green meaning back to work like normal, soon. And red is, we are still in some sort of isolation in a year. And so the question is, how does that impact the milestones that you make and your cash burn and your cash runway? So you're not having, so that no matter what the scenario is, you have a financial plan of that you're executing on. Now, for example, would lead you towards, let's say, a yellow or a green? Sometimes it's about good luck, bad luck. If you're doing a first-in-human study and it's normal human volunteers and no volunteers and the hospital's not open, that's a big red flag. If you're on oncology studies and no matter what with COVID, you don't want to die of cancer, so you're going to be doing the clinical trials, that's sort of like, I'd say whatever, life-sustaining, then some of this are the studies that we have in our portfolio companies are going on sort of as usual. So those are, and then the other piece is like outsourcing. So what we're seeing a lot of is we don't just have India CROs and China CROs. We now have US CROs, because depending on who's shut and who's open, you can get your animal work or your chemistry done in whatever country is less impacted. And I guess similar to what Bernd was saying, or maybe it was Patrick, what we're also seeing is that if you're raising a new series, like a Series B, it's really hard to find a new lead. So we're seeing a lot of the inside syndicate either doing an insider-led round or extending or bridging with convertible notes. And so I guess the real challenge is, where are we around the corner when we get more into the normal dynamic of new money and new leads coming in and having a more healthy, expansive syndicate. So that would hopefully be when we're in the green phase, but a lot of folks are resisting doing those types of new investments until they can see the companies, in person.
Meredith, Gilles, additional points, if you have?
I would just pick up a little bit on what Marian said, which is the in-person piece. For us right now, I would say deal flow has not slowed down significantly, but that's because we had quite a bit sort of coming into COVID that we're now, working through. Also because we focus internally so much, we spend a lot of time incubating with things. And so we have a lot of those going. Where my concern is, frankly, is in those new investments coming in over the next 6 months, which would start to kind of trickle in now. Are we seeing those or not? And I would say it's so much of that is built on network, being in person and just boots on the ground, that it'll be interesting to see what we have to do in order to solve for those pieces if we can't, if we're at red light and not green light, as Marian said. And so I'm not so worried about pipeline right now, but I'm worried in 6 months to a year what that's going to look like, depending on how this just lands, because are we going to get JP Morgan? Are we not? Right? Or, what's going to happen to the places where generally we meet each other and talk about these things, and how are we going to be able to convert over to this new paradigm in order to keep that pipeline up longer term?
Excellent point.
And on our end, we haven't seen a decrease in the number of opportunities. If something has changed, we have seen slightly more US company coming to Europe for funding. But in really in the peak of the confinement here in Europe, we were able to close 3 refinancing, and we were even able to achieve a significant trade sale in June. So not real big impact. But I do agree with Meredith. Well, we're going to see that, last quarter this year, maybe the impact will be higher.
So to the audience members, this is fascinating, because let's keep 2 things in mind. Number one, this time lag between quality deal flow, or the impact of COVID and the quality deal flow. Not seeing it now, but maybe 6-9 months down the line. On the other hand, this sort of quote unquote cognitive dissonance that we are seeing in terms of number of companies going public, and the valuations that they are commanding, and what seemingly is very robust capitalization in the public markets, which we will come to in a second. But maybe, Arturo, moving on to the next question.
Yeah,
on
sure. Yes, a good question. I think it was really interesting, the comments that you make, Meredith and Gilles. So maybe we can elaborate a little bit into that. I mean, how can you identify the winners to some extent of this race? And the other quick question would be regarding these changes that you envision in the future. I mean, are there any contingency plans or any ideas around to just, try to boost the current companies to make it through these times? Maybe Meredith, you want to take that one?
For our current companies, I think we, like everybody else, went through and looked and said, how recently had they been financed? Where are they clinically? Because those seem to be the 2 critical elements as to what their health was going to be in the near to long term. We were, I think, in some ways fortunate, because we are fairly early in our fund and we're early stage investors, that the clinic is usually a lot further off for us than other groups. So we were fortunate in that regard, both in having not that many clinical stage, which is an odd thing to say, but in the framework of COVID actually is an advantage to some extent, as well as also a significant amount of fresh and very significant financings. And I think that has been helpful to us, and I'm sure some of the other folks who are investing within the US at least, to comment on that, the size of financings here, both in private and certainly now public, including one of our portfolio companies, aescuvest, who I know there are some other folks here who are familiar with them. We're able to pull a tremendous amount of dollars and resources and commitment that I think will hopefully help them through, let's call it the COVID winter. But whether other companies will be as fortunate longer term, I think is TBD, and something that we're going to really have to think about as those companies, even as in our portfolio, are starting to get closer to the clinic because they are able to continue to work through COVID, as well as also potentially need more follow-on financing.
Mm-hmm. No, that's really interesting.
Okay, I mean, my concern is more about what is outside than what is in our portfolio, because in our portfolio, the largest impact has been on the company which are clinical, and so some clinical trials were put on hold, or the recruitment was really lower, and at the peak of the confinement, we had an estimate of about an average 4-month delay in all the clinical trials through the portfolio. And I am happy to say that in July, what we've seen is this recovery of the clinical trials, speeding up recruitment, and the average estimate we have now is 2 months. I mean, most of our companies have been able to, pick up some of their delay in the clinical trials, and we are now only 2 months behind schedule on average, which is very good. And so what we did was just to make sure that we had enough reserve to be able to bridge should that be necessary to deliver the results we invested for. So from the portfolio viewpoint, I'm not sure this is going to be that huge. We'll see in the end. But that's, if it continue this way, if we don't have significant second wave, that should be manageable.
I think the challenge is for some of these seeded companies that aren't yet syndicated with a full Series A. It's just, and let's say with first-time entrepreneurs or science that's super early, those are the ones I think that are having a lot of challenges with traction, and are being creative in terms of saying, can we partner with other more mature companies, let's say with a low dollar stock swap, those kinds of transactions that would help to keep the assets moving, but don't require the more standard syndication. So they are, and so I've heard of instances like that where you might want to call it pre-portfolio. And I think those are the ones I think that would have done probably better outside of COVID, because there would be more opportunities to socialize with more potential lead investors.
And we shouldn't forget one thing. There are also a lot of companies out there that are not developing drugs and that have products on the market. Medical devices, diagnostics, life science tools, and they suffer a lot. The sales drops that we've seen in our portfolio, depending on the product you have, range from 10% in the best case and up to 90%. If your customers are, let's say, research departments or pharma companies, you're in a good shape. If you're selling directly to hospitals, well, say a prayer. And there we have a big difficulty. And fortunately, in Germany, we have this tiny little invention called short work. So it means also for startups, you can send your people home. They're not working, and a part of their salary is taken over by the government, which is outsourcing staff costs, which is absolutely great, because if the economy recovers and you need the people, well, you just take them from home and you have the same highly qualified people and no time lag in between. That's extremely nice for the time being. It's also very expensive for the government. However, we believe that for the economy, it's a great invention.
commenting on who's going to be a winner or not. Tough one, certainly, but quickly going into vaccines. Usually, I'm a very optimistic person, but in that case, I have to say I'm not a strong believer that we are going to see a vaccine on the market in Q1 next year. I'm going to see this definitely later, despite not being a vaccination specialist, by the way. When it comes to other solutions, drug, digital devices, honestly, I think we have to take a bird's eye perspective and also should consider it from a perspective. The crisis, really hit us early this year, so February, March, depending on the market, and then honestly, we have to take quite some time to observe what's going to happen. In other words, it's so unfortunate, so unlikely that we are going to see any winners emerging a couple of weeks later. I think we're talking about such complicated stuff that we're investing in that it's highly unlikely that we see the super innovation just a couple of days later after the crisis has emerged. So therefore, it's really hard to say, and we have to observe what's happening on the market. But for now, I cannot really see a clear winner, so to say.
Another interesting aspect is there's still a lot of war on talent, even though we're in somewhat isolation. So the winners are going to get like the best people, because I see people moving around, job to job. So, the companies perhaps that are either more well-funded or the science is a little more mature are attracting talent. So that is something I wouldn't necessarily have predicted.
Yeah. That's interesting times. That's a good topic, Marian. So yes, out of interest. So how does attracting talent to companies works in these times where, there are travel bans and we cannot move around?
It's hard. Sorry, Meredith.
Well, I was just going to say, I can really speak for the Boston area, which is quite unique in that, it's such a robust community. And everyone kind of is 1 degree of separation from each other. A couple of my companies honestly are seizing, Marian, on what you just described, which is companies we know that are not going to be funded and top talent out of there. And we are working through our networks as quickly as possible or directly with recruiters to, as soon as we have a candidate like that identified, shamelessly reach out and try to get them. I mean, to some extent, I think it's the way our business works. But certainly right now in particular, I would say we're even honestly more, not aggressive, but more aggressive in trying to get those hires because we've been able to keep a lot of our labs going to some extent and because we have the funding. And so we're honestly taking to full advantage of what we can when we see top talent becoming available here.
You know what? I love technology, but I even more love to be a human being. So when I talk about, our just recent recruitment processes, thanks to Zoom, Teams, and other capabilities, everything went fine. But when it came down to trust, at one point in time, you need to meet people. And I'm so much looking forward to do those things physically and face-to-face again at one point in time.
That's a good point. So the feeling actually is that, Zoom meetings work well, but what do you think about the human touch? I mean, it is something essential. Yeah, go on.
It is essential. We've had a recent experience with hiring somebody from outside of Germany, a very nice guy for our team, and just 2 days or 3 days prior to the agreed beginning date, we lost him for explainable reasons. But to be honest, if you meet person to person, you might be able to develop a better feeling for the real motivation and how serious the people are. And a personal meeting is, to my mind, not replaceable. Also to attract more people, because it's not only that we get an impression from the candidates, we also have to give our candidates a good impression of our organization. And also that works a lot better in Bonn or Berlin, where we have offices, than just via Zoom or Teams.
I think also, board meetings, for example, with Zoom seem to be very effective rather than having to have someone fly from France to Boston for a 4-hour meeting and back. But the but is to the human touch is the board dinners the night before are where you really forge the friendships, the trust, getting to understand each other as human beings, which is sort of missed in the Zoom meetings where you're not interacting one-on-one with whoever's sitting next to you at dinner, and you're not doing the small talk. So as much as I like the fact that the Zoom board meetings are efficient in terms of time and even carbon footprint for the airplane, fuel, etc., there is something that's going to be missing, and I don't know, and I think that that's hugely valuable. I'm not sure how we'll replace that.
But Marian, a question for you based on that. Don't you think that one of the outcome will be more frequent board meetings, some of which being Zooms?
Yes, and it could be more a matter of how you schedule those, to your point. In other words, it doesn't have to be quarterly in person. It could be a combination of the Zoom and the in person. So I could definitely imagine that in the future. Yep.
Let me use some marketing gossip to explain what we're talking about. Face-to-face is for acquisition, and Zoom is for retention.
That's a good one.
Well
so
said.
Then the idea of
Patrick.
Zoom board dinners is not a good idea.
Right.
Okay.
So one additional thought though. So I would have never imagined that for a company going public, doing TTWs online was ever possible, right? Because you go in as a crossover investor or a public investor, I think you go in, make a decision very quickly, subtly different from a venture investor who are more engaged throughout the diligence process. But we did see a couple where, for the first time ever, I suppose, we didn't get to meet the management teams before making a decision. So one of the questions that arises from that is, it's our sort of internal mindset and the stringency which we ascribe to this. Hypothetically, and heaven forbid that this situation continues for 9 more months. So in that situation, I think our internal stringencies and the necessities of having to meet a group in person will perhaps be loosened, and we will get used to the fact that we have to do Zoom meetings or recruit people. But one thing's for sure, in this environment, there is this strange sort of enforced Darwinian selection in some way, right? Of the haves and the have-nots, which will get enforced from a capital perspective, from an operating perspective, and also from a talent perspective. I'm very curious to see how this evolves, but over time, I suppose, if this goes for 9 more months, we should be doing recruiting online or via Zoom, irrespective of what Patrick said in terms of that was very catchy and absolutely true. It captures the spirit very well. So I don't know, have you guys thought about, for example, when we started back in February, let's say, are you less stringent now about meeting people on Zoom and making hiring or other sort of board decisions, or have you maintained the same level of stringency? Just to expand on Arturo's question.
As what said earlier was been said earlier, people contact, direct contact, is not replaceable by any kind of technology. So to your point, what might happen is we build through our network. For example, maybe I will not fly to New York to meet a company if you're in the syndicate and I can ask you to meet those guys on behalf of the syndicate. That I can live with. But not having someone I trust, having had a direct contact with people in who you're investing or the people you're going to hire, on our end, I don't think that will be ever possible.
Very pertinent point, Gilles. Thank you. Anyone else?
That reminds me of the 3D printing principle, that you have a local hub and get your devices wherever you are on the planet. Nice one, Gilles.
Yep. Excellent. On that topic, anything else to cover, Arturo, or should we, given the time we have at hand, move on to the last question?
Let's move on.
Yeah.
Your turn, Bibhash.
Yeah. So, let's go back to the point around, how we are seeing private deals versus public deals. The public markets seem to be on fire. The private markets are beginning to see the haircuts in valuation when we go into them, right? That was one of the takeaways and sort of the common observation. So, and we also talked about this Darwinian selection, haves and have-nots. So let's put all of that together and think through what are we anticipating broadly from the biotech sector overall. Are we too decoupled between the realities of the market and private biotech? Maybe lessons from the last time this has happened. What are our key takeaways? What would you like the audience to know and be aware of as we go into the next several months? And maybe we can start with Gilles.
I mean, for the audience to take away is, please do not take public market as reference for the valuation of your companies, because it's not related really to the underlying quality of the product being developed by the companies. To me, current valuation has a lot to do with the central bank sending a huge amount of liquidity into the economy, and people having access to this liquidity at no cost or very low cost, and taking risk with this money, which doesn't cost them anything. And to me, part of the very high valuation is driven by this mechanism, which has nothing to do with biotech. So main message is public market is not always the right valuation for companies.
Perfect.
I think by the same on a different note, the IPO market is obviously going to create future positive opportunities for private companies, because as venture firms are enjoying the returns, once that liquidity can flow back to them, their LPs are going to be very pleased and be signing up for new funds, et cetera. So, and, certain funds that might be evergreen, obviously are going to be bolstered up by that. So I think that it bodes well, I think, for the medium term in terms of, biotech startups not having to worry too much about a dearth of capital. But that being said, they're going to have to compete very effectively with whatever the value proposition is and the differentiation they have for that capital. But I think it's positive, not just on the short term, but potentially the long term. That's assuming, of course, that the public market valuations stay steady, and there isn't future downturn in the market that that impacts everybody.
Sounds good.
Yeah, the marks for our recent public companies are really exciting right now, but we also are in a blackout period, right, as investors. So while we can enjoy those on paper, Marian, back to your point, when we actually are in a position to sell, I don't know what the market is going to look like. So it's an exciting opportunity for our companies to, acquire cash that's going to get them to critical value inflection points. It's exciting in that, we can make a potential exciting, great return for our investors, right? And in my case, on behalf of our hospitals. But I certainly don't feel like I have, as a private investor, an ability to predict the future of what those stocks are going to look like in 6 months' time or more, as we think about actually exiting them.
When I worked in investment banking many years ago, we always heard the saying, the market is always right. In this case, in this very special environment, I believe the market is not always right. And as a seed investor, we have to take a different perspective anyway. It takes between 8 to 12 or even more years to bring a company from the seed investment to the exit, being that an IPO or a trade sale. So we always, and also this time, we have to rely on good people, good technology. The same old rules still apply. I'm not saying these are the only rules, but because it could be that you're missing a profit because you're not listening to the market. But in the long run, don't follow the market. Yeah, the market of today. It's misleading.
Yeah, go, Patrick. Sorry.
Due to the situation we're in, investing in healthcare is absolutely en vogue, especially on the public side of the house. And there we see strong emotional drivers going down that route. And probably we as professional investors have to influence or have to be some sort of role model in that field to decouple the emotions from the facts, and probably with our analytical thinking, where to steer, where to invest, we can balance a little bit what's going on in the public markets these days.
Yeah, and building on that topic, I think it's a great take-home message. So we have 5 minutes, and actually we have one question from the Q&A from the audience that it's related to that. So the question is, can you name some examples on companies that you would like to have for balancing your portfolio during these times?
There's one for me. There's an interest in an application for COVID, and they're looking to get, let's say, non-dilutive funding to pursue that angle. And then the whole rest of the business model is preserved. In other words, the venture dollars are going towards the original premise and indication. So that's one example of how you can parse it out, still pursue it, but not necessarily fund it with venture dollars.
We had a portfolio company who was now just become clinical stage, and COVID patients fit quite well into the indications that we were pursuing. And so we basically assembled a clinical advisory board to help us vet and understand whether we want to pursue that or not. I think that made sense because it was right in front of us, and we could decide whether we were going to go after it or not. But we didn't. But none of our other portfolio companies chased. Right? It was because it was right there. I think that made sense, and we will still take a decision on whether we will pursue that or not over time.
Okay.
Anything that makes nightclubs and dancing possible again. I'm joking. So anything that's supporting the path from sick care to healthcare. So anything that's in the preventive space is highly and warmly welcomed. So I don't want to see a lot of stuff when it's too late in the long-term future. Want to see a lot more stuff, to prevent things.
Excellent. So, gentlemen and everyone, just given the time remaining, maybe we can spend like 30 seconds for each of us on sort of crystal ball gazing on how, as from the investor seat, we are thinking of the next several months, and sort of if you have to give one key advice, which I think Bernd and Gilles has already given, what would it be to the companies and the members in the audience? Maybe we can start with Gilles once again.
I would say stick to the basics of innovation development, data, good quality data, and data again. That's how you create value for companies. Forget about the vogues or anything.
Marian?
I would say, do your best to, in terms of the acquisition versus retention, like I've been trying hard to figure out how to acquire new networks, new colleagues, like even though it's on Zoom. And so it takes effort, but I feel like I can't take a break in terms of expanding, my network and understand what's going on. So even though it's different and it's not ideal, I think I think keep on forging those relationships would be my advice.
Brilliant. Patrick?
I would say, dear impact investor, continue to make green deals, but white deals are as equally important as making green deals. So continue to invest in healthcare or invest even more in healthcare?
Perfect.
I would advise all founders to stay passionate. Good ideas will survive.
Meredith?
I think that we are still an industry that has to innovate to stay alive. This is an interesting time, and the innovations that will arise from that, I think we touched on, will be in many different parts of the industry. And so to pick up on what Gilles said, we need data, and we need to set a high bar, but I think we should still use this time to bring new models into play and to not be afraid of that, right? Whether it's a new modality, a new business model, or even a new investment thesis, as Patrick alluded to, all very important and all have an opportunity to be created at this point in time.
Excellent. Arturo, finishing thoughts maybe from you, and then...
I think the finishing thought is whomever came with the idea of doing Zoom board dinners definitely will earn $1 million. But yeah, no, I think it was great. So just wanted to take the opportunity also to thank the panel and to thank the organization and everyone in the audience, of course, for this time. And yeah, give you the floor to you, Bibhash, to finish.
No, absolutely. Same thoughts. Hopefully the audience enjoyed the discussion and had some takeaways, at least a peek into the minds of very different sets of investors, and have a sort of the common theme that emerged from here. Please take some of the things that were said with, just as opinions that come from where each of us sit. And hopefully you enjoy the rest of the conference. Thanks, everyone.
Thanks to the hosts.
Thank you.
Cheers, everybody.
Thank you.